Let's get the presentation up and we are good to go. Cool. So we're going to talk about angel investing in healthcare. This is going to be a little bit different than what I normally talk about because instead of me talking about how we invest, I'm trying to do a little bit more to talk about why people should become angel investors and that it is not actually as hard as it may seem. Or the barrier is not as high, I should say. It's still hard. Bit of background on myself. I am an investor. My entire career has been on the investment side. I've collectively managed about $500 million globally. Tons of transaction experience. I've done hundreds of companies, seen 1,000 more. Been involved across 20 plus countries at this point in time, every continent. I've been working in Asia for 12 years, been living here I think 7, now 8 years almost. I run the Founder Institute, which is how I heard about Disruptive Doctors in the first place. They were in one of our cohorts. I'm also the founder and managing partner of Indelible Ventures, which is a seed stage VC. Seed stage meaning that we invest at the early stage. There's generally a product in the market. There's a little bit of revenue, but it's not very far along. And so what we're going to talk about is a few things, some definitional aspects in regards to what is angel investing, a little bit about why you should care, and then we'll move into more of like the nuts and bolts, how you should get started, and hopefully a call to action that's going to end up inspiring people to do a little bit of action after that. So what is angel investing? Well, generally, angel investors are going to end up being high net worth individuals. It doesn't necessarily mean that you have any sort of massive wealth, retired on an island, or anything like that. It just means that you have sufficient enough disposable capital that you're able to invest in early businesses that are just now getting started. Angel investors are the early capital. I'm sure a lot of people have heard like the friends, family, and followers. Some people replace the followers with fools, but we try and avoid using that terminology. But the angel investor is usually the first money that goes in order to support that business, which is why they called them angels. They are doing a service and being helpful in order to give that important source of funding in order to get started. And because of that, angel investors have a really outsized economic impact when it comes to startup creation. Without this source of capital, there's many startups that just would not be able to get up and running in those early days. And that kind of leads into this other aspect in regards to why is angel investing so important. It has a huge impact when you're talking about being able to get up off the ground and actually get started. It takes money to make money. When you're starting up a business, you have to be a little bit bootstrappy. Oftentimes you're going off of personal savings. So bringing on that angel investor is a really critical component because it gives you more depth in order to invest in the R&D, the go-to-market, to really be able to make that startup that you're trying to go after more viable. Now, the other aspect, which we can dig a little bit more deeply into, is when you're talking about angel investors, an important aspect of it is the unique value add that those angel investors bring to the business beyond just the capital. So in a forum like this, where everyone's probably coming from the same healthcare profession, if you're talking about angel investing in healthcare, the unique value add is that you're not only bringing capital, but you also have specialized expertise in that field where you may be angel investing. Now, it's not necessary that you angel invest solely in your field of specialization. Obviously, you would want to diversify. But there's an aspect of an angel investor that you're bringing additional value, whether through network connections, knowledge, expertise, etc. There's a long list of additional value add that comes from it. And oftentimes, that's one of the special benefits that angel investors bring. So from the startup's perspective, they're often trying to look for sources of early capital that can provide additional leverage beyond just having a higher bank balance. Finding somebody that can actually bring value, whether through knowledge, network, etc. And that ends up having strong network effects throughout as you can end up increasing the viability of the business. Now, what's in it for the angel? Well, there's a number of different possibilities. You know, you can group them into financial versus non-financial. One key aspect is, you know, by investing in early stage startups, there is the potential for large, outsized financial gains. If that company does well and you invested at an early stage, at an early valuation, and that company grows to become a very large business, you can do very well financially. There's the potential for high returns. You can also look at it from this perspective that you're supporting the ecosystem, you're supporting innovation. You can get that kind of feel good beyond the financial gains of supporting things that are going to make an important impact on this space that you care about. There's the aspect of, there's an additional aspect of many people like angel investing because it gives them an opportunity to give back, not just financially, but via mentorship and other sorts of interactions with the startups. This is quite critical as well because I talked about before, there's a very important aspect beyond the capital that angel investors provide, which is being that source of mentorship, guidance, network, that long list of additional value add that is capable of being provided. Now, when you think about the last aspect that I have listed on here, because of the chance for high outcome rewards, it's high risk, high reward. When you think about your overall portfolio, as you start to accumulate more wealth, it's an aspect of diversification. It's an aspect in order to build some level of, let's call it more speculative, but not necessarily in a negative viewpoint, but you're allocating a little bit of your portfolio into something that can be high risk, high reward. It's not going to negatively impact you if something doesn't work out, but if it does, it can end up being very financially rewarding. Now, when you start thinking about undertaking it, as we start getting a little bit more into kind of the practicalities of this, first key step is that you really want to try and get an understanding of what the startup ecosystem is. Now, some of you may already know, some may be not too familiar, but there's really a couple key aspects in regards to who are the players. And when I talk about who are the players, you have really the startups and then you have the different stages of investors. And the second bullet point that I want to highlight here is that you really need to understand that venture is really a pathway. Venture is not the sole option for any business. But if you're talking about a venture scalable business, so if you're talking about going the VC path, it is a pathway. The companies that are going to end up taking this route, they're going to raise from angels. They'll likely raise again for a seed round. They'll likely raise again and again and again. And so the important thing here is understanding the important dynamics that the capital that goes in the early stage necessarily needs to take into account what the next steps in the journey are, not just from a business viability, sales, go-to-market, etc., but it needs to take into account that fundraising pathway, if that is the route that the company is actually pursuing. So you as the investor need to understand that even though you may think, and this has happened on a number of occasions, there's a number of angels that I've seen that put overly punitive or negative terms inside of a term sheet when they're investing. On the surface, you look at it and say, well, these are all meant to address risk. But the problem is what happens, what's intended to be a risk mitigation actually ends up becoming a negative, because what happens is when some of these things take place, the likelihood of raising that additional round of funding at the next step of that pathway ends up being lower. So by trying to be a little aggressive, extract more out of the deal, etc., you may actually end up reducing your probability of a positive outcome. So something to be cautious about. Have conversations. That's a little bit too wonky for this presentation. We can, if anyone's interested in the specifics of what I'm actually referring to there, I'm always happy to have a conversation. But let's jump into the next part, which is kind of getting started and go through a little bit of the highlights in regards to this. Again, this is not going to be super exhaustive. I've got a limited time span here, so I'm just going to hit the highlights, yeah? So the first aspect here is assessing your financial readiness. You need to understand what your time commitment is, how much time can you actually dedicate to this process. Then you got to do your research, establish your goals, start building some network. So let's dig into a couple of these pieces and really talk about it. So assessing your financial readiness, you need to be able to understand, when I started talking earlier about allocating a portion of your portfolio, the first key aspect is understanding what your net worth is. Determine what your goals out of investing, out of being an angel, what are your goals and what are your risk tolerance? How much could you potentially lose without caring, basically? And also understanding the risk tolerance from a liquidity standpoint. Because the key important thing to understand if you're going to pursue angel investing is that it's a long-term horizon. You're not able to get in and get out very easily. So if you have liquidity constraints, you need to take that into account. And then this all leads into developing a budget and a little bit around an investment schedule. So I'm going to do like some simple math. I'm not going to go heavily into detail, but I'm just going to do some simple math here and throw it up on the board, which is this example scenario here. And oh my, the white is barely readable. So I'm going to end up having to read this out. Okay, so that was, I clearly used the wrong color font. But basically what this is saying, it'd be easier if the numbers were there because when I say it out loud, it's a little bit hard to follow. But anyways, so let's say hypothetically, you're analyzing your financial condition and you say, okay, my net worth is $5 million. And then you say, okay, well, I'm keen on doing this venture thing. Let me figure out a portfolio allocation. I'm gonna do it relatively low, and I'm gonna say 5%. 5% for $5 million. Now you're talking about allocating 250,000. Ah, nice. He's got the. We'll just wait for him to put that. Now it's visible. Okay, so. So you look at $5 million, you say, I'm going to allocate a portfolio percentage of 5%, almost. And now I've got $250,000 that I'm looking at allocating into angel investing. So now you end up having your budget in regards to what you're looking at investing. Now you say, okay, well, I want a decently diversified portfolio. That's not going to be 250K all into one company. So now I look at it and say, okay, well, I did a little bit of research. I don't want a heavily diversified portfolio, but I want enough companies in my portfolio of angel investing in order to get that little bit of diversification. So let's say 20 companies. We're targeting 20 companies. We look at it, okay, 250K divided by that 20, we're going to do 12.5 per investment. Angel investing doesn't actually have to be very large ticket sizes. You can find opportunities at this denomination. Now let's look at it and say, okay, well, I'm not going to do it all in 1 year. It's not going to be like one go and boom, I've just put all this money out to work. So let's hypothetically say that I'm going to build up over a little bit of time and say over time, I'm going to accumulate this percent of my portfolio. So now I say, okay, well, I'm going to do it over 5 years. That's going to be 4 investments per year, basically putting out 50K per year. So this is the kind of math. When you're looking at wanting to get into angel investing, this is kind of like the back of the envelope. You can get more detailed. If you got a financial advisor, if you got someone trusted, you can always reach out and have a chat with me. No worries there. But this is basically the sort of math that you want to end up doing. I've seen a lot of instances where individuals get excited about it and they say, hey, I want to jump in and start doing angel investing. They go too fast. And what happens? They've exhausted the amount that they've allocated to be incapable of investing, and now there's no allocation unless they end up overextending themselves in regards to the percents of their portfolio. So be cautious. The same way professional managers like myself, we have a finite pool. I wish I had an infinite pool to where I could just nonstop, anything that I like, I'm just going to jump into. But you have to be a little bit selective. You have to understand what your cadence of deployment is going to end up being like. So before anything, sit down, what's my net worth, how much do I want to allocate, and get kind of an understanding of what does this translate into a per year.